Hey, you're back with Conversations with a CPA podcast. I'm Crystal Stevenson. I'm your host and CPA. Today, we're going to be talking about choosing the right filing status. Did you know that something as simple as selecting the right filing status on your tax return can save you the most in taxes? Are you looking for ways to save money in taxes this upcoming tax season? If you are, then you'll want to stay tuned to this particular episode. Today, we're talking about filing statuses, which one to choose. You're going to see the difference that it makes in your tax situation with some case scenarios. We're going to be giving you some digestible information in a practical way that you can use when you're ready to file your taxes. Okay, let's get it.
Let's talk about money. When it comes to taxes, ain't nothing funny. Hey, let's talk about the choices that we make in our lives. Do I save, invest, pay my taxes? What's right? Let's find a solution that will make all our financial troubles go away. Welcome to the podcast, Conversations with a CPA. Conversations with a CPA.
Okay, so here we go. Tax filing statuses. We're going to be going over tax scenarios that you can use to identify some tax savings for your own situation. Okay, why is this important? Your tax liability will depend greatly on the filing status that you choose. So, depending on your personal situation, you could qualify for more than one, but it is your job to work with your tax professional to make sure they have all the information necessary to make sure they're choosing the right one for you. There are different types of filing statuses. Let's go through them quickly. You have single, married filing jointly, married filing separately, head of household, and qualifying with or with dependent child. In this discussion, we're going to be using a case scenario where a taxpayer is making $30,000 in wages, and for the married filing separate status, we're going to assume that the spouse has no income. So we're just going to be working with a minimal amount of income just so that you can see the tax difference that it makes. But if you multiply this number by thousands of dollars, hundreds of thousands of dollars, you'll see how significant the tax savings can be going from one status to the other. Now, before we get into breaking down the case scenario, I want to make sure that you understand the way that the tax return flows because you're going to need to understand that, okay? So the way that your tax return goes is that it always starts with the gross income. And then you always subtract out your adjustments to income. Adjustments to income can be things like student loan interest deduction, a contribution to a traditional IRA. Once you subtract the adjustments to income, you derive at your adjusted gross income. This amount is so critical. The adjusted gross income, there are a lot of areas on your return that are limited based on the adjusted gross income. So when you're looking at tax planning, you want to try to reduce the adjusted gross income as much as possible. After you determine what your adjusted gross income is, you'll subtract your standard or itemized deductions, okay? And then for 2020 was the first year that this started, but the charitable contributions are able to be subtracted within limits on the front of the tax return, even if you don't itemize. So that would be subtracted. And then there's a special deduction called the qualified business income deduction. And that's for sole proprietors or self-employed individuals who have income. You can get up to a 20% deduction of your net earnings from your business. And then after you subtract out all of these amounts, you're derived at what's called your taxable income. The taxable income is what determines your tax rates and what rate you're going to fall in. So you can end up falling in a 10% bracket, a 12%, all the way to 37% is the top rate. After you determine what your taxable income is and what the tax rate is going to be, what the amount of taxes are going to be owed, you can subtract out tax credits. Generally, other taxes get added in, like if you were self-employed and you had self-employment taxes that will be added. There are no tax credits that can be subtracted or go against your self-employment tax and certain other taxes. And then you subtract out any tax payments that you made throughout the year. And then finally, any refundable credits. The refundable credit, the new one that we had last year, was for the stimulus checks. For those, it was the recovery rebate credit. That's a refundable credit. Our income credit is a refundable credit. So just an example of what are refundable credits. So once you have the payments and the refundable credits subtracted, then you finally come down to the amount of tax that you owe, or if you paid in more than what you owe, then you're going to get a refund. Now let's look at the example again. Let's go back to the case scenario. And we're looking at a taxpayer who has earned $30,000 in wages. So that's their gross income. And they are filing single or as married filing separate. Going to have the same rates for this particular example. So for single and married filing separate, if you do not itemize, then you'll take the standard deduction. So they're going to subtract out $12,400. These are the 2020 tax return deductions and amounts, but these amounts get adjusted based on the cost of living year over year. Okay, so it might be slightly different for 2021. Okay, but for you to get the gist of what I'm talking about, this is perfect. So if you are filing a single or married filing separate and you have $30,000 of income, you're going to have a standard deduction that's going to be subtracted from that income of $12,400. That's generally going to leave a taxable amount of $17,600. So on $17,000, you're going to pay about $1,948. Now let's go down to the same taxpayer, but now they're married. Their spouse doesn't have any income, or this is going to be the same scenario if you're a qualifying widower with dependent child. You'll get a standard deduction of $24,800 now. So that standard deduction is double the amount that it was for single and married filing separate. So now $30,000 minus the standard deduction of $24,800 gives you taxable income of only $5,200. So your taxable income is grossly reduced from $17,600 in the previous example down to $5,200 now, just with the change of filing status. Now your tax liability is reduced to $523 versus $1,948. Now we look at head of household. For head of household, the standard deduction is $18,650. So if you're a single person with a child, or you're a grandmother taking care of your grandchild, whatever your scenario may be that qualifies you as head of household, your standard deduction is going to be even higher than a single person. The single person, again, was $12,400. Now, head of household, that $30,000 in wages is going to be reduced by a standard deduction of $18,650 in this example. So now your taxable income is $11,350. Your tax liability on this income would only be $1,138. So this is head of household is already showing better than filing as single or married filing separate. Now, let's look at this a little further and compare married filing joint to married filing separate, because I always get the question, is it better to file separate or jointly if you're married? The standard deduction, as you can see, doubled to $24,800 versus $12,400. So this is great even for married couples where only maybe one spouse works. You still get the benefit of an additional $12,400 of a reduction in your income that you're going to have to pay taxes on. I think that's great. The taxable income, if you look at the fact that when you started with $30,000 of wages, when you subtract the standard deduction from married filing joint, it only left $5,200 of taxable income versus $17,600 as a single person. So this is a prime example where you can see that if you're married filing separate, you're ultimately going to be paying more in taxes than if you were to file joint. Most often that is the case. Even with much higher income brackets, it's going to be the same scenario. So what can we take away from this? Tax planning is critical, okay? Working with a tax professional that can run through the scenarios and that you feel comfortable, first of all, sharing the pertinent information that is necessary for a tax professional to make the right decision on your behalf. After you find the right tax professional, you want to engage in tax planning. You want to strategize not just for the upcoming tax season. You want to work with someone over the long term and throughout the years to make sure that you're optimizing your tax situation. Life changes. As you go on, life will change. So maybe you were single this year, now you're planning on getting married. Having a conversation of married filing joint versus married filing separate is always a great conversation to have with your CPA. Tax projections is also another great benefit to something that you should do with this information. You want to have your tax professional run different projections, run different scenarios for your situation so that you can see what will actually work for you. That's going to be critical for you. So now hopefully you can see the importance of choosing the right filing status. It can make a whirlwind of difference. And this is just a very simplified way of looking at it, just to hone in on the importance of when you start your return, the first question is, what is going to be your filing status? And now you understand the difference that the answer to that question makes, okay? If you are married, then your options are married filing joint versus married filing separate. And you see that in most cases, married filing joint is going to be the best option for you. And then if you're single, but you have a child, it's going to be way better for you to make sure you qualify for head of household versus single. If you're caring for someone, a relative or someone, it's always great to talk to your advisor to see if you still qualify for a head of household and if you can claim those individuals that you're caring for as dependents on your return. So we do have another episode that will discuss that in more detail. So you'll want to check it out. Thank you for tuning in to this episode. I hope that this was valuable to you. If you would like to share any of your comments or ask any additional questions related to the information that we shared in this video, we'd love to hear from you. You can also follow us on Instagram and so all the social media platforms. We're out there. Thank you so much.
Let's talk about money. When it comes to taxes, ain't nothing funny. Hey, let's talk about the choices that we make in our lives. Do I save, invest, pay my taxes? What's right? Let's find a solution that will make all our financial troubles go away. Welcome to the podcast, Conversations with a CPA. Conversations with a CPA.